Let's talk more about inflation data here. Core PCE coming in hotter than expected, up 0.4% in April compared to the expected 0.3%. As the Fed's preferred inflation gauge, this print will weigh heavily in the June meeting, as we were just discussing. Joining us now, Chris Rupkey, Forward Bonds Chief Economist. Chris, thanks for being here. Yeah, inflation it will not come down as fast as anybody would hope. And in fact, we saw a reacceleration in April here. What's the Fed going to do?
Well, they really want this core PCE inflation, consumer inflation, to come down to about 3.5% by the end of the year, which means the monthly increases have to run 0.3% on average. And we didn't get it. We got 0.4% today. I mean, we do get a look at CPI before the Fed makes their next decision, but the market in the days running up to today's report is already betting on a rate hike at one of the next two meetings to 5.5%. And, you know, a 5.5% Fed funds rate, the core inflation is 4.7. I mean, that, you know, are rates really restrictive at this level of even 5.5%? That's why you hear some people talking about, well, back in the 80s, you know, they would have gotten interest rates much higher than inflation, which in today's terms would mean something like 6 or 7% for the Fed funds rate to slow the economy.
To your point, Chris, could you see us hitting 6% before the year's out?
Well, I think the Fed kind of knew this all the way along. They were kind of secretly hoping that somehow inflation would come down. Don't forget, Powell said himself that he was surprised how inflation moved from goods to services, and now it's stuck in services. But that's what happens when you let the inflation genie out of the bottle. It just prices just keep on going, unless you get interest rates to very, very restrictive levels. And I think if they would have come out even 6 months ago and said we need to push the Fed funds rate to 6 or 7%, obviously people would have freaked out. So it's kind of a gradual process. But if the Fed does pause, they kind of fall further behind here, and they risk that they need to push interest rates to 6 or 7%. At this point, I can only see a hard landing, and the hard landing to bring down inflation. And the hard landing's not going to happen without a significantly higher federal funds rate, unfortunately.
Chris, why isn't inflation coming down more? Is it still a supply issue? Is it just a demand issue? What is going on?
I think this is what happens. Once it gets out, again, I hate to use the inflation genie all the time, but you know, once it keeps getting out, you know, it moves from consumers back to businesses. Consumers get more wages because they look back and see inflation and they ask their bosses for a raise to match inflation. It just becomes so circular. It's very, very hard to break that. Don't forget, in the 70s, they had campaigns from the president to whip inflation now and stuff like that. It's just very hard. And people, you know, sometimes governments will lean on corporations and say, why are you raising prices? And, you know, corporations will say, well, my costs are going up or wages are going up. It becomes so circular. It's almost impossible to break it, this cycle of passing on price increases from one entity to another without a sharp slowdown in the economy, meaning basically a recession. We don't really have any experience with inflation falling without a recession or a near recession miss, if you will, which means in the old days, it meant more joblessness, higher unemployment rate.
And I got to ask you one question that's kind of a cloud hanging over everything right now. What is the risk that you see to the economy, although it looks like we will have a deal with regard to the debt ceiling deal, or debt ceiling negotiations, I should say, right now?
Yeah, you know, we've seen this back in 2011, and it's nice to hear a debt deal's coming, but you know, part of me just doesn't want to believe it. It's so complicated. If we get it through the House somehow with Democratic votes, you know, you still need 60 votes in the Senate. I mean, maybe it'll all go well, but you know, part of the Congress thinks we have a spending crisis, and they're willing to risk a debt default to get spending down. I mean, I have to admit, total outlays are like what 6.3 trillion expected this year, and they're arguing over like 700, 800 billion of non-discretionary fiscal outlays. Only 10% of the total outlays. So, part of the electorate's going to be very angry about government spending, and it just seems like it's going to be very difficult here. They're going to push. I did go back. It wasn't widely known at the time, but obviously Washington officials would be remiss if they didn't take a look at what to do if there was a debt default. And they have put plans together back in August 2011, and I assume those plans are there again, where they could prioritize budget outlays. They don't want to do it, but they would certainly roll over the debt that comes due, and they would pay out all interest on Treasury securities. I think they have that plan in mind. Now, if they talk too loudly about that, that's just going to embolden the deficit hawks, the spending hawks on the other side of the aisle, the Republican side. It's a mess out there. I think it's going to be quite bumpy here in the next couple of months.
Yeah, I mean, Janet Yellen certainly has been doing the opposite, saying how dire it is going to be. So she definitely has not been talking up that emergency plan, if you will. Chris Rupkey, thank you so much for your perspective. Forward Bonds Chief Economist. Appreciate it. Have a great weekend.
You too.